presentation is all about buying a home. We will learn what you need to know, when to invest in a home, the essential finances involved, how to choose a real estate agent, house hunting strategies, closing on a new house, and guidelines for selling the house you already have. Let's begin with the things you need to consider before buying a home. First, don't buy unless you can commit to remaining in one place for at least a few years. If you can't do that, then owning is probably not for you, at least not yet. With the transaction costs of buying and selling a home, you may end up losing money if you sell any sooner, even in a rising market. And when prices are falling, that's even a worse proposition. One thing you should do is check your credit report. Since you will likely need to get a mortgage to buy a house, you must make sure your credit history is as clean as possible. A few months before you start house hunting, get copies of your credit report. Make sure all the facts are correct and fix any problems you discover. And then you aim for a home you can truly afford. The rule of thumb is that you can buy housing that runs about 2.5 times your annual salary. For an even better estimate, there are many calculators available online to help you. If you can't put down the usual 20%, you may still qualify for a loan. There are a variety of public and private lenders who, if you qualify, offer low-interest mortgages that require a small down payment. This one's important. You buy in a district with good schools. In most areas, this advice applies even if you don't have school-age children. The reason is when it comes time to sell, you'll learn that strong school districts are a top priority for many home buyers, and this helps to boost property values. Obtain professional help in the process of buying and selling your home. Even though the internet gives buyers unprecedented access to home listings, most new buyers and many more experienced ones are better off using a professional agent. Look for an exclusive buyer agent if possible who will have your interests at heart and can help you with strategies during the bidding process. Choose carefully between points and rate. When choosing a mortgage, you usually have the option of paying additional points, which is a portion of the interest that you pay at closing, in exchange for a lower interest rate. If you stay in the house for a long time, say 3 to 5 years or even more, it's usually a better deal to take the points. The lower interest rate will save you more in the long run. And before you begin your house hunting, get pre-approval from a lender. This will save you the grief of looking at houses you can't afford and put you in a better position to make a serious offer when you do find the right house. Not to be confused with pre-qualification, which is based on a cursory review of your finances. Pre-approval from a lender is based on your actual income, credit, and debt history. Do your homework before bidding. Your opening bid should be based on the sales trend of similar homes in the neighborhood. So before making it, consider sales of similar homes in the last 3 months. If homes have recently sold at 5% less than the asking price, you should make a bid that's about 8 to 10% lower than what the seller is asking. And hire a home inspector. Your lender will require a home appraisal anyway, but that's just the bank's way of determining whether the house is worth the price you've agreed to pay. If you hire your own home inspector, preferably an engineer with experience in doing home surveys in the area where you are buying, his or her job will be to point out potential problems that could require costly repairs down the road, and you want to know those things before you buy the house. So, how do you know if you're really ready to own a home? Home ownership means you no longer pay monthly rent for the roof over your head. You can do what you want with your house, within reason, of course. When you leave, you can sell it to recoup the purchase price and, with any luck, earn a profit too. But don't kid yourself. Home ownership comes with a slew of disadvantages as well. Responsibilities and some headaches. Grass needs cutting, and there are regular home maintenance tasks as well as repairs. So before going any further, Consider whether your lifestyle and finances make home buying a smart move. High costs mean you should be prepared to stay put for a little while. Except in a roaring real estate market, it doesn't usually make sense to buy a home you'll own for less than 3 or 4 years. The reason is the high transaction cost of buying and selling property means you could lose money on the deal. If you do make money, you'll pay capital gains taxes if you're in the house less than 2 years. When home prices are falling, it just makes the case against buying even stronger. So ask yourself if you can really stay put for that long. Will you need to move because you are transferred by your current employer or a new one? Are you thinking of going back to school? Those kind of things should help you decide whether you want to rent a little while longer or begin thinking about owning your own home. It may make more sense to rent. On the financial side, one key question is whether it costs more on average to rent or own in your area. The rule of thumb is that if you pay 35% less in rent than you would for owning, and that includes the monthly mortgage, property taxes, homeowners fees, insurance, all that stuff, then it's smarter to consider renting. So, if you're ready to buy a home, you need to get your finances in order first. And this is before you even actually start hunting for a piece of property. This means to collect a pile of cash for the down payment and closing costs and convincing a bank to lend you an even more staggering sum, generally 80% or more of the purchase price. So first, you start with your credit. Credit reports are kept by 3 major credit agencies: Experian, Equifax, and TransUnion. Among other things, they show you whether you are habitually late with payments and whether you have run into serious credit problems in the past. A credit score is a number calculated from a formula created by Fair Isaac based on this information in your credit report. So you have 3 different credit scores, one for each of your credit reports. A low credit score may hurt your chances of getting the best interest rate or getting financing at all. So get a copy of your reports and know your credit scores. Try Fair Isaac's myfico.com for reports and scores from Equifax and TransUnion. Experian scores and reports can be accessed from Experian.com. So you take a look at those websites. Errors are not uncommon. If you find any, you must contact the agencies directly to correct them, which can take 2 or 3 months to resolve. If the report is accurate but shows past problems, be prepared to explain them to a loan officer. Next, you need to determine how much house you can afford. You can start with one of the many available calculators on the internet. For a more accurate figure, ask to be pre-approved by a lender who will look at your income, debt, and credit to determine the kind of loan that's affordable for you. The rule of thumb here is to aim for a home that costs about 2.5 times your gross annual salary. If you have significant credit card debt or other financial obligations like alimony or even an expensive hobby, you may need to set your sights lower. Another rule of thumb: all your monthly home payments should not exceed 36% of your gross monthly income. The size of your down payment will also determine how much you can afford. The bigger the down payment, save up some cash. If you haven't already, you'll need to come up with some cash for your down payment and closing costs. Lenders like to see 20% of the home's price as a down payment. If you can put down more than that, the lender may be willing to approve a larger loan. If you have less, you'll need to find loans that can accommodate you. Various private and public agencies, including Fannie Mae, Freddie Mac, the Federal Housing Administration, and the Department of Veterans Affairs, provide low down payment mortgages through banks and mortgage companies. So if you qualify, it's possible to pay as little as 3% upfront. You can check those websites for more information. However, with a down payment under 20%, you will probably wind up having to pay for private mortgage insurance, or PMI. This is a safety net protecting the bank in case you fail to make payments. PMI adds about 0.5% of the total loan amount to your mortgage payments for the year. So if you finance $200,000, your PMI will cost you $1,000 annually. Once you've considered the down payment, make sure you've got enough to cover fees and closing costs. These may include the appraisal fee, loan fees, attorney's fees, inspection fees, and the cost of a title search. All these fees can easily add up to more than $10,000 and often run to 5% of the mortgage amount. If your available cash doesn't cover your needs, you do have several options. First-time homebuyers can withdraw up to $10,000 without penalty from an individual retirement account if you have one, although you must pay taxes on the amount. You can also receive a cash gift of up to a certain amount from each of your parents without triggering a gift tax. Gift taxes are paid by the donor, not the recipient. Also, check on whether your employer can help. Some big companies will chip in on the down payment or help you get a low-interest loan from selected lenders. And you can also tap your 401k or similar retirement plan for a loan from yourself. Don't buy a home without professional help. With all the tools and advice available today, ranging from books and magazines to online advice, it would be possible for you to buy your home almost completely without the aid of a real estate professional. That's not necessarily recommended, though. The housing market, like politics, is basically local, and each state, city, and even neighborhood has a thicket of local laws or customs that you need to understand. For that, it helps to have a team of professionals to guide you. You might want to start by finding an agent who can represent your interests in the search. This is not as simple as it sounds. Sure, 85% of sellers list their homes through an agent, but those agents are working for the seller, not you. They're paid based on a percentage, usually 5 to 7% of the purchase price, so their interest will be getting you to pay more. What you need is what's known as an exclusive buyer agent. Sometimes buyer agents are paid directly by you or on an hourly or contracted fee. Other times they split the commission that the seller's agent gets upon sale. A buyer's representative has the same access to homes for sale that a seller's agent does, but his or her allegiance is supposed to be only to you. Well, to complicate matters, there are hybrid agencies called either single agency or dual agency brokers. In both cases, an individual agent in the firm may represent either sellers or buyers, and sometimes both, in the same transaction. Potential conflicts of interest abound in this situation, so if you are seeking a buyer agent, but no exclusive buyer agent is available, make sure to ask the agent about conflicts of interest. There are dozens of websites to help connect buyers with buyer's agents, some of which are listed at the bottom of this slide. Next, start looking for a mortgage lender. Take your time, since you could be paying this loan for 30, even 40 years. Start on the internet. Listed are reliable websites to begin your search. These sites carry nationwide listings of mortgage interest rates and other related information. But don't limit your search to the web. Once you have an idea of the best rates from national lenders, get on the phone to your community banks and any other institutions for which you may have a relationship. Ask if they can beat the national rates. Often the local lender can afford a better deal simply because he or she knows the local market and wants to keep your business. And you might also consider using a mortgage broker. A mortgage broker is a middleman who keeps tabs on rates from a multitude of lenders. The mortgage broker isn't paid directly by you, but gets paid by the bank. However, the fee, usually 1.5% to 3% of the loan amount, may get transferred to you in the closing costs. Most search engines have extensive listings of mortgage brokers. There's also a trade group called the National Association of Mortgage Brokers, which can put you in touch with a broker in your area. Once you've done all that, it is now time to start the hunt for the perfect house. Your first step here is to figure out what city and neighborhood you want to live in. For overall demographics and data on metropolitan areas, you can visit a city site like Best Places to Live or search different real estate websites. You can look for signs of economic vitality, a mixture of young families and older couples, low employment, and good incomes. All of those are the demographics information that you can find. Pay special attention to school districts. High teacher-to-student ratios and graduation rates are numbers that you can look at. The school districts need to be good schools, even if you don't have school-age children, because when it comes time to sell, you'll find that when you have a strong school system, it's a major advantage in helping your home retain or even gain its value. Try to get an idea about the real estate market in your area, and these are some websites that can help you do that. So once you've established your criteria, it's then time to begin physically looking at homes, and your real estate agent may be able to show you listings that fit your criteria. Incidentally, if you have that flexibility, consider doing your house hunt in the off-season, generally meaning in the colder months of the year. You have less competition and sellers are usually more willing to negotiate. And there are plenty of real estate websites which allow you to search for a property that fits your requirements. Be aware of choosing search criteria that are too restrictive. For example, select a price range 10% above and 10% below your true range. Add a 10-mile cushion to the location you specify. If you see a house you're interested in, save it, print it, add it to your bookmarks or favorites list, and take note of the MLS code. Your agent will want that code in order to arrange to show you the home in person. When you actually start touring homes, bring a notebook and a digital camera to help you remember details. Your real estate agent should supply you with a description of each house and the lot it sits on, the property tax assessment, the asking price, and sometimes a diagram of the rooms. Your camera and notebook are there to record other details ranging from the cost of heating to the view outside the back window. Just remember, don't automatically reject a house just because it doesn't measure up to your desires, either in feature or price. You can always add a deck, for instance, or update a kitchen. Since the asking price is just a starting point for negotiation, you will be making offers and counteroffers as both parties seek an acceptable price, and those things are taken into consideration. If you're a first-time buyer, an alternative may be a condominium or a cooperative, or co-ops as they're called. Condos generally sell for 15 to 20% less than the cost of comparable detached homes in the same neighborhood, so you can get much more space for your money. But what's the difference between the two? In a condo, each owner has absolute ownership of his own unit, which may be an apartment or townhouse. Owners pay a monthly fee to maintain shared areas like the lobby, the pool, or the laundry room. The chief financial risk to a condo owner is that the common charges can rise, or in the event of a major problem such as a roof repair or boiler replacement, the condo board can assess fees to cover such large expensive repairs. So it's a good idea when considering a condo to find out how much the common charge has changed over the past 5 years and whether there have been major assessments during that time. Also, ask what percentage of the residents actually own their units as opposed to just renting them. Many condos include both options. A complex with a lot of renters has fewer owners who care about the upkeep, and it may be harder to get a loan on such a property. Each co-op is usually limited to major metropolitan areas, especially New York City. Essentially, the complex is run by a corporation where each owner is a shareholder. In other words, a co-op owner is a partner in a building rather than an outright owner of his or her specific unit within that building. The monthly maintenance fees are generally higher than those of a condo because they may include property taxes. Condo owners pay their own separately, but prices tend to be lower. The chief downside is that the co-op board usually has to approve new owners and may discourage you from renting your unit if you move out without selling. As with a condo, check on the group's financial health, whether shareholders have been hit with special assessments recently, and whether the unit includes many renters. No matter what you choose, the time will come to seal the deal on a new home. So you have to exercise those haggling muscles. Once you find the house you want, you need to move quickly to make your bid. If you're working with a buyer's broker, then get advice from him or her on an initial offer. If you're working with a seller's agent, devise that strategy yourself. Try to line up data on at least 3 houses that have sold recently in the neighborhood. Calculate the difference between the original price and the final price of the home sold. If the average difference is, say, 5% below the asking price, then you know you can make an offer 8 to 10% below, leaving yourself a little room to negotiate. If you really want the house, don't lowball. The seller may give up in disgust. Another factor to consider in determining your bid is whether the trend in recent home sales is up or down in the past year. For instance, if houses a year ago were selling at list and recent ones are going at 3% below, you might want to sharpen your pencil for your opening bid to just 5 or 8% below the list price. There is no foolproof system for negotiating a fair price. Occasionally, it's best to deal directly with the seller yourself. More often, it's better to work exclusively through intermediaries. In general, don't let the other side begin to believe you are negotiating in bad faith or being deceptive. Any deal you eventually reach has to involve trust on both sides. Be creative about finding ways to satisfy the seller's needs. For instance, ask if the seller would throw in kitchen and laundry appliances if you meet his price, or take them away in exchange for a lower price. Remember, too, that your leverage depends upon the pace of the market. In a slow market, you got some muscle. In a hot market, you may have none at all. Once you reach a mutually acceptable price, the seller's agent will draw up an offer to purchase that includes an estimated closing date, and this usually happens 45 to 60 days from the acceptance of the offer. Have your lawyer or buyer's agent review this document to make sure the deal is contingent upon obtaining a mortgage, a home inspection that shows no significant defects. Make sure you're clear on the definition of significant. Your meaning and their meaning could be completely different. And make sure it's contingent upon a guarantee that you may conduct a walkthrough inspection 24 hours before closing. This last clause allows you to check the home after the sellers have moved out so that you have time to negotiate payment for repairs, just in case the movers caused damage or that big living room sofa was hiding a hole in the floor. You also need to make a good faith deposit. This is usually 1 to 10% of the purchase price, and it should be deposited into what's called an escrow account. The seller will receive this money after the deal has closed. If the deal falls through, you will get the money back only if you or the home failed any of these contingency clauses. That's why you have to make sure they're there. You're almost done. It's time now to call your mortgage broker or lender and move quickly to agree on terms, if you have not already done so. This is when you decide whether to go with a fixed rate or adjustable rate mortgage and whether to pay points. Expect to pay $50 to $75 for a credit check at this point, and another $150 to $300 for an appraisal of the home. Most other fees will be due at the closing. If you don't already have one, check into a homeowner's insurance policy. Ask for recommendations for friends, your lawyer, or real estate agent. Most lenders will require that you have homeowners insurance in place before they'll approve your loan. In addition to the appraisal that the mortgage lender will make of your home, you should hire your own home inspector. Again, ask for referrals or check with the American Society of Home Inspectors, a trade group. An inspection costs about $300 on average, but it could go up to $1,000 for a larger job, and it takes 2 hours or more. Ask to be present during the inspection because you will learn a lot about your house, including its overall condition, construction materials, wiring, and heating. If the inspector turns up major problems like a roof that needs to be replaced, then ask your lawyer or agent to discuss it with the seller. You will either want the seller to fix the problem before you move in or deduct the cost of the repair from the final price. If the seller won't agree to either remedy, you may decide to walk away from the deal, which you can do without penalty if you have that contingency written into the contract. About 2 days before the actual closing, you will receive a final HUD statement from your lender that lists all the charges you can expect to pay at closing. Review it carefully. It will include things like the cost of title insurance that protects you and the lender from any claims someone may make regarding ownership of your property. The cost of title insurance varies greatly from state to state, but usually comes in at less than 1% of the home's price. The lender might also ask you to establish an escrow account, which it can tap if you fall behind on your mortgage or property tax payments. Lenders can require deposits of up to 2 months' worth of payments. After all of this, the actual closing is often anticlimactic, though perhaps still nerve-wracking, of course, for some, as this could be someone's first huge financial commitment. Now, if you are currently planning on selling your home, preparation and timing can help you get the best price. When you decide to sell, the first thing to do is investigate the local housing market. Consult the large real estate sites to see how similar homes are priced in your neighborhood. Many newspapers also list the selling and asking prices of recent sales, plus how long these houses were on the market. Note the prices for your neighborhood during the last several months. Check how sales were running, say, a year ago, so you get an idea of whether the market is heating up, cooling down, or staying put. This exercise should give you a sense of what your home is worth. The next step would be to select an agent. You may decide that you can sell your home without an agent. It's an attractive thought since you would save the 6% of the selling price that the broker typically collects. But balance that against the work involved in advertising a house and being available at all hours to show it. If you do decide to work through an agent, ask for referrals from friends or check the websites and local newspapers for advertisements. Don't simply accept any recommendation. Make an appointment with an agent and interview him or her for the job. Evaluate the person as though you were a buyer. Is he or she professional and personable? Does he say the right things to make you want to see the home? Also, since the agent will be likely to advise you on a selling price, how well does his or her price jibe with the homework you did already on your own? Don't be fooled by an agent who is merely flattering you with an inflated price. Go by what you already know about your house and the current housing market. Ask whether he or she will be the agent actually showing the house. Some brokers have specialists whose main duty is to win the listing. Then another of the broker's agents take over. Understand how commissions are distributed. So once you find an agent that you like, you have to formally sign a listing agreement. This is a contract laying out the specifics of your arrangement, including how long you will let this agent represent your home and what the compensation will be. Many agents prefer an exclusive listing, meaning you agree to pay a commission regardless of whether the agent is actually responsible for finding the seller. You should commit for no longer than 3 months, 1 month in a hot market. In case you find the agent lacking in enthusiasm, you don't want to be locked into a binding situation that lasts forever. When you discuss the listing agreement, discuss other issues as well. For instance, if there are certain times when you want the house off limits for walkthroughs, let the agent know. Also consider negotiating the commission. If your house is expensive, an agent might not flinch if you suggest 4 or 5% instead of the usual 6%. Conversely, if you know it's a buyer's market, consider offering the incentive of a higher commission if the agent can land you a sale within 5% of your asking price. After you've signed a listing agreement, you may want to give your lawyer a call to notify him or her that you're selling your house and will need help reviewing bids and contracts. If you don't want to pay for a lawyer, your agent should also be able to guide you through this process. Next, get ready for an open house. Whether you sell on your own or work with an agent, you'll want to spruce up your house before it goes in the market. Take an objective look at it. Is it cluttered? A little worn and tired? Consider a new paint job. Tidy up. Move unneeded furniture into the attic, basement, or rented storage. Remove some of your personal items like family pictures and knickknacks. Mow the lawn. Plant flowers if it's the right season. These seemingly insignificant details can add many thousands of dollars to your eventual sales price. If you're no good at this kind of thing, consider hiring a home stager, someone with experience preparing homes for showings. Their fees can more than be offset by quicker sales and higher selling prices. Speaking of which, you need to settle on an asking price. In doing so, forget what you originally paid for the house, how much you've spent on renovations or remodeling, or even how much money you need to move on to your next home. When it comes to pricing your property, the only yardstick that matters is what comparable homes are selling for in your neighborhood now, which may be more or less than you originally paid for it. Your research will already have given you a good idea of how the market is faring. Your agent should also provide you with comparable sales and discuss why your house should be priced lower or higher. And then, timing is the key. Note how long homes in your area were on the market. If you're in a seller's market with listings moving in a week or so, think about adding a premium to the asking price. In a buyer's market, it's especially to get the price right. The critical selling time is within the first month after your home hits the market. If the price is too high, you'll turn off potential buyers and agents and then have a hard time attracting them back, even if you lowered your sights later. When you receive a bid, ask your agent for guidance on how to respond. This will depend on how you price the house, what the housing market is in your area, and your urgency to sell or wait for a better price. Make sure your lawyer or agent reviews the contingency clauses included with the bid. For example, it's generally not a good idea to agree to sell your home with the contingency that the buyer must first sell his or her own home. Also, make sure that all the buyer's contingencies are restricted within specific amounts of time. For instance, if the deal is contingent upon the home passing an inspection, then the inspection must occur within a week or 10 days of an accepted bid, or, you choose the time period. The same is true of the closing date. Make the buyer commit to a reasonable date, and that's usually 45 to 60 days from acceptance. I hope this has been helpful to you, and best of luck to you when it comes time to buy a home and sell your home.